We're in the throes of a massive US dollar funding squeeze, and this has resulted in a major surge in an already strong US dollar. The dollar is at its highest levels in years against many of its peers, including a jaw-dropping run against the pound to its highest levels since 1980s. The pound has suffered mightily from coronavirus management missteps and falling oil prices, and the currency is now desperate to find its footing. Hits to commodity block and emerging market effects are also notable, though here the setbacks are less surprising given the risk-correlated nature of these currencies. The big source of stress out there is the stress around the global economy being completely exposed to future negative shocks now that we have seen already exhausted central bank policy accommodation and government stimulus efforts throwing whatever is left to contend with coronavirus fallout. Investors are running to cash, and that cash right now is best viewed as the US dollar. US T-bills have dropped below zero, while longer-dated US government debt yields have risen as well. The market sees the T-bills as a form of cash given their liquidity relative to their longer-dated counterparts. If we're to look at the technical extension alone, it does seem like we're very close to a point where we should expect the panic to die down, at least for a bit, and at least with respect to the dollar demand. Currencies are severely extended against the US dollar, with indicators warning of a reversal ahead. This, coupled with the fact that disorderly movement in FX is not welcome and the US administration won't be pleased with such an aggressive upswing in the buck, leads us to believe that we should indeed expect some dollar selling to kick in sooner than later. It's worth noting that despite the dollar surge, the euro has still been supported ahead of its yearly low. We think this will be a good barometer going forward, and we'll be looking for the euro to hold up above the 107s. We also believe the market has overreacted with respect to the pound weakness and continue to see the pound in the process of carving out a major bottom at longer-term cyclical lows, with the more compelling risk-reward to the top side. We think the market has been far too aggressive with pound selling, and we anticipate the cable rate will look to quickly establish back above 120 in the days ahead. That's all for now.